Hello! So here we are, we're up to class 9 on Monday, Wednesday, Friday class schedule, and this is class 7, video A on Tuesday, Thursday. So Tuesday, Thursday folks, you're going to have to watch another video. Sorry about that little interruption. Alright, so we're talking about the adjusting process in this first part of the chapter. So up till now, we've learned that transactions are occurring all throughout the month, let's say, and we write them down, we analyze them, we journalize them, and we post them to the ledger. So things are happening. We're performing services and getting revenue, we're purchasing things, we're running up expenses like supply expense, salary expense, and we're journalizing all those as they happen. Alright, so that's great, and so far we've learned that we use all that information to make the financial statements. And we do, but the truth is there's a little step that comes before we do the financial statements because we do accrual-based accounting. So here's what you need to know. Every month at the end of the month, every year at the end of the year, at the end of an accounting period, the accountant sits down and thinks about what other entries need to be made. Like, what haven't we accounted for that needs to be accounted for? And we call those adjusting entries. We're just correcting the accounting entries to reflect what actually happened during that period. Alright? So if you can imagine things happen like you buy a long-term asset like a building, right? Well, we use some of that up, right? We have to depreciate it. So that's an adjusting entry. You might have had an employee work for you, so you owe them a salary, but they're not going to get paid for, say, another week. So you have to put that down, right? So there's a few things we have to adjust to take care of the books. And that's what we're doing now, these adjusting entries. So we're going to learn a little bit about the adjusting entries, why we do them, how we use them, and that's what this video is about. Just learning about accrual basis accounting and these concepts of revenue recognition and matching. So if you're following along in your notes or with the PowerPoint, let's talk about cash versus accrual based accounting. So, first idea, cash accrual. There are two ways to record transactions: cash basis accounting and accrual basis accounting. Cash basis records transactions based upon the receipt or payment of cash. Right? That makes sense. If you get some cash, you write it down. Under cash basis, revenues are recorded only when cash is received, and expenses are recorded only when cash payments are made. So already you probably are saying, wait a minute, I know that we had those accounts called accounts payable and accounts receivable, and so we don't always get cash every time. Exactly right. So we don't always use cash basis accounting. What we've been learning is accrual basis accounting. Accrual basis records the effect of each transaction as it occurs, when revenues are earned and expenses are incurred. Therefore, revenue is recognized when the service is performed, not when cash payment is received, as the receipt of cash may occur at a later date. So that's what we've learned already. We just weren't calling it accrual basis accounting. When we did those transactions that was on account, that was accrual basis accounting. We were putting them in the period when they occurred. We didn't wait for the cash to change hands. Accrual basis accounting is required by generally accepted accounting principles, what we call GAAP. Cash basis accounting is not allowed under GAAP. So that's why we haven't been learning it. All along we've been learning accrual basis accounting. And so cash is, you're only doing a recording when cash changes hands. Accrual, when the actual revenue is earned, when we do the work, or when we incur the expense, and maybe we have a payable, maybe we have a receivable. But we have to actually put it on the books when it happens, not wait for the cash. All right. So let's talk about this idea of a time period. I think you've probably heard me or Dr. Huff talk about at the end of the period, for this period, and we're doing transactions within a certain period, right? So that's the time period concept. The time period concept simply states that a business's activities can be sliced into small time segments, such as months, quarters, or years. Typically, a company's fiscal, that's F-I-S-C-A-L, fiscal year spans a period of 12 months. A calendar year is a fiscal year that begins on January 1 and ends on December 31. Many companies begin their fiscal year at the beginning of a quarter following a slow period. For example, retail organizations like Walmart, JCPenney, Target may have a fiscal year from February 1 to January 31, since January is a slow month following the holiday season. So you may recall that when we prepare financial statements, we're writing for the year ended, and up till now I think we've been writing December 31st, but not all companies use a calendar year. Some of them, especially retailers that have a busy Christmas season, they'll have their fiscal year end like end of January or end of February. So that way it's a slow time and they can do all that accounting stuff and not be real busy accruing more transactions. Revenue recognition principle. I bet you noticed in that when we were doing transactions in chapter 1 and 2 that sometimes we had something where we earned some revenue and then we set up an account receivable, right, when we didn't get the cash. That's because of this principle. So you've been doing it all along, you just probably didn't know it was called a revenue recognition principle. The revenue recognition principle dictates when a journal entry is required to record revenue and the amount of revenue to record. So this is a rule about how we recognize revenue. In addition, the amount recorded for revenue is based on the actual selling price of the item, not necessarily the retail price. For example, if we normally sell an item for $200, but it's currently on sale for $100, then when it is actually sold for $100, the amount of revenue recorded will be $100. The original sales price is irrelevant, doesn't matter, because the item was not sold for $200. It was sold for $100. So this revenue recognition tells me that I record it when it's earned, right? So you may recall that we had that account called unearned revenue. Do you remember that account? It was a liability, right? Because we still owed people work. Well, that's why we're not recording it as revenue. We're recording it as a liability because we haven't done the work yet. You have to earn it to call it revenue. So it may be different from cash collections. That's why sometimes when we do work but don't get the cash, we still put the revenue down. We just put it down with an account receivable. And revenue based on the actual selling price. So no matter what you have it on your books at, like say it's in your inventory at a certain price, you don't put that down if that's not what you really sell it for. So you have to put the real selling price to recognize the revenue. All right, so these are important concepts. You record revenue when it's earned. It could be different from cash, right? You may not trade cash, you may get a receivable, and it's based on the actual price. All right, the revenue recognition principle guides when to record revenue and the amount that must be recognized. Under accrual basis, and that's what we do, US GAAP says accrual basis is what we use. Under accrual basis accounting, revenue is recognized when it is earned. So that's how we know it's revenue and not unearned revenue. It's been earned. So what does earned mean? Well, the earnings process is deemed complete when the seller has either delivered a product or performed a service. So this is kind of easy to think about. So when we recognize revenue is when we've actually done that service. So if you're a plumber and a person calls you up and says, hey, I need you to come fix the leak in my shower, and you say, sure, I'll come over on Tuesday, it'll be $200. You don't get to put that $200 on the books until you actually go fix the shower. So you have to finish fixing it to earn it. Suppose they give you $200 up front. They say, well, here's your $200. I'm going to go on vacation. Here's the key. You come over while I'm gone and fix it next week because I don't want to deal with plumbing issues. So just fix it while I'm gone. Well, you got the cash, but you haven't done the work yet, so it's still not revenue. So it's actually revenue when you do the service. That's when you put it on the books as revenue. Now, did you put the cash on the books? Sure. When you got that cash, you put it on the books, you called it unearned revenue, right? So you needed to do something with the cash, right? But it's not revenue. Performed a service, delivered a product. So if you're a salesperson, a lot of times custom jobs, hey, you have to pay up front. You can imagine you run a surf shop, you make very special custom surfboards, and you won't be able to pay up front for those because, you know, they got special airbrushed art. Nobody else is going to want somebody else's name on their surfboard. You can't sell it if they don't pick it up. So you make them pay up front. Well, you got a busy business. You're not going to be able to make that surfboard for a month. So they pay up front, and then you start making the surfboard a month later. So you've made the surfboard, and the person doesn't come pick it up for another month. Well, you don't get to recognize that revenue until that person, you deliver that surfboard to that person, right? That's what we mean by delivered the product, right? When it's actually done, that's when you put the revenue on the books. The matching principle. This helps us with expenses, all right? So the matching principle guides accounting for expenses and states that all expenses are recorded when they are incurred during the period and are matched against the revenues of the period. The purpose of the matching principle is to accurately record expenses in the same period as revenues to compute an accurate net income or net loss for the time period. For example, rent expense and salaries expense for November should be matched to the revenue earned during November. All right? The building was used during November and the employees worked during November as well. Therefore, revenues and all applicable expenses will be reported in the same month to ensure proper accounting for monthly transactions. So the matching principle is simply saying we have to match up our expenses with when the revenue is occurring. So even though we didn't get any cash or maybe we didn't pay the expense, we're matching it to the proper period, right? So you can imagine that we buy materials up front, right? I'm that surfboard shop, right? And so I go and I buy some foam, right? Is that what's in the middle of them? Foam core and some fiberglass and some paint, and maybe I buy an airbrush to do some fancy painting on it. So I buy my materials and even some equipment up front, right? Well, I paid a bunch of money up front, but it's not an expense yet if I don't have any revenue to match with it, okay? So don't put the expense until you have some revenue. So when you sell that custom surfboard, now you know, okay, I had these expenses that went with that surfboard, And so I made that surfboard in November and I delivered it in November, so I'm going to match those expenses to that particular month because that's when I made that surfboard. The equipment, say you buy a paint sprayer to airbrush the surfboard, right? Well, that's going to be spread out over a long time, right? Because you're going to use that for more than one surfboard. So we have a special kind of expense matching. We call it depreciation. And we'll learn a little bit about depreciation in this chapter. So for Monday, Wednesday, Friday people, that'll be next class. For my Tuesday, Thursday folks, that'll be on the next video. So just keep in mind, here's what you got to remember. We do accrual basis accounting, which means we recognize revenue when we earn it, not necessarily when cash is exchanged, because people may pay cash up front, but you haven't done the work, so that's not revenue. Or you may do work, but you're going to bill them later, right? So it's revenue when you do the work. Even though you didn't get the cash, it's still revenue, right? So just when you do the work or deliver the product, that's when you put it on the books as revenue. Expenses have to be matched to their revenue as best we can. So things like wages, even though maybe you only pay people on Wednesdays and the month ended on Monday, well, you're going to have to recognize those wages for the month, right? So we'll learn how to specifically do it. We'll practice some transactions. But for now, remember, recognize revenue when it's earned, match expenses to the revenue. All right, good luck, and I'll see you on the next video.